Hello again, everybody, and welcome to the Options Mentor. Well, what an interesting week we've had this past week with the SPX and the market running all over, kind of breathless, hanging on to whatever news they could get out of the debt limit ceiling meetings. It's still in the throes of that right now. We're up a little bit. It's working off of good news, but the volatility has certainly ticked up. We were all the way down 16 and I think a little below at one point, and now we're back up in the 19 area on the VIX. So we've been all over the place. Volatility has climbed a little bit. We did have the FOMC minutes, which really there wasn't a whole lot to that. And now we have a 3-day weekend coming up, the holiday coming. So I want to talk about a trade today that, given the increased volatility, that I don't know that we'll go down that much anyway. As long as we're above 15, this particular trade works fine on the VIX between 15 and 25. And I'm going to talk about a short-term butterfly. So let's take a look here as I share my screen. And we'll take a look here at this butterfly that I have set up that is for June 16th. Now, June 16th is, of course, I forgot how many days out that is, but wrong direction, Mark. That's your problem. Always helps if you're reading things right, doesn't it? All right, so it is 22 days out, and this trade is set up by putting your shorts at the money. So if you put this trade on, say, next Tuesday or whatever, just put the shorts at the money or around it, usually within 5-10 points, and then up 60 for the top long and down 70 for the bottom long, which is what I've done here. So once again, maybe we're trading at 41.70 on Tuesday or something. So you'd center it there and then appropriate up 60, down 70. Now, the idea of this trade is to get out of it at around an 8 or 10% profit. Now, volatility, of course, could help you a little bit here. Shouldn't hurt you too much because volatility normally is a little friendlier to flies once you're in them. I still like to put on flies when the vol's a little higher, and we definitely have that pop up here recently, so I don't mind putting this on. But if we just tick ahead here in time and we just look at the P&L open, now this will just be based on theta. So if we put this trade on and it is $16, we'd be looking for about a 10% profit, which would be about $160, which should be here just on pure theta, maybe around June 1st, which I believe is next Thursday. So even though this trade's placed out 22 days, or maybe if you don't put it on until Tuesday, less than that, obviously, it's not like you're going to be in it for 20 days. I would expect to be out of this trade in a week. If you have to adjust it, maybe 10 days, 12 days. But, if you're trying to get 8 or 10% and you get it in that amount of time, to me, it's well worth it to be able to do that. Now, I have set this trade up with calls. You could do it with puts if you wanted. Just remember that since it's asymmetrical, meaning the one of the longs, in this case, the upper long, is closer to the center strike than the bottom long. If you do it with puts, they margin it differently. And what happens is they margin it as a debit spread and a credit spread. So actually you would pay this little debit of 610 and have about 980 in margin. But if you do it as calls, it's the same price, except it's all in the debit. So you're not saving 1 penny by doing it in calls or doing it in puts. It doesn't matter. It's just the money's coming out of your account. It's just whether they call it part of the debit or whether they call it margin. But if you do it with puts, just remember you want to combine your margin, in this case $980, and your debit, those two together, and that will tell you what I want 10% of, right? So around $1,600. Or you could just do it with calls and it'll all be there, $1,620 if you got filled there at the mid. Now, a little bit about fills. You don't have to get filled right at the mid price, which is halfway between the bid and the ask. I always start there. But I think a lot of times in SPX, you're going to probably have to give up a nickel or even 10 cents off that. That's not a concern. You can do that. And then this trade, like I said, we'd look to be out of this hopefully in a week, maybe 10 days, try to get 8 or 10%, and then just get on out of this trade. So I think this will make sense in the coming week. I do think volatility will probably still be in the range, even if we go down a little bit. I expect over the weekend, if we get a debt ceiling deal, you'll probably see the market rally a little. I don't look for a huge rally. And then maybe the volatility will drop, but it's not going to drop below 15 over the next week. I'm pretty sure that we still have whatever the Fed's going to do looming, and inflation, and the economy. You got the commercial real estate on a cliff. So there's plenty of things there to keep the tension high, to keep that VIX above 15, really, no matter what. I don't look for it to get below 15 for the rest of this year, given everything that's going on, but I guess we'll see. All right. Well, once again, folks, I appreciate you coming by. Please subscribe to this channel and like the videos. And if you can, spread the word, trying to get a channel growing here to get the information out about what we do with option training and option education to help folks educate themselves on what options could do for their portfolio. So have a great one, everybody, and I'll speak with you again next week. So long.